2 months ago, I made a video when SPY was at 645. Markets were down, Iran was in the headlines. People were terrified. Today, the market dropped hard. Everyone is panicking again. S&P is sitting at around 735. That is higher than when I filmed that panic video. And what is causing today's sell-off? A jobs report. May payrolls came in at 172,000 jobs, more than double the expected, 80,000. The economy added far more jobs than anyone could have predicted. That sounds like good news, and for the economy it really is. But here is why the markets hate it. A strong jobs market means that the economy is running hot. A hot economy keeps inflation elevated, and when inflation stays high, the Federal Reserve has no reason to cut interest rates. In fact, it may just do the opposite. Economists are now predicting a 70% probability on a rate hike before the end of the year. This hits growth stocks, especially tech and AI. Here is why. The value of a growth stock is built on future earnings, money that you expect to make in 2 or 3, perhaps 5 years. When interest rates rise, those future earnings are worth less in today's money. So the higher the rates go, the more expensive these stocks look, and the harder they will fall. The irony is that 2 months ago people were panicking when S&P was at 630. Today, they are panicking at 735. The crash that they are scared of right now is still 105 basis points above the bottom that everybody already survived. The bottom of the Iran crash, the absolute low, was around 630. My video was filmed at 645, on the way down, while things were still getting worse. Then the market recovered, and S&P ran all the way to 760. So it's the same people, same fear, just a different number on the screen. But the pattern is here. It's the market's cruelest trick. It doesn't just crash once, it shakes us out repeatedly, at higher and higher levels until people finally sell. Think about what just happened in 2026 alone. February and March, Iran war breaks out. S&P goes down to 630. Everyone says it's over. Everything is over. April, we had a full recovery in just 11 trading sessions. People who held won. In May, we had the S&P ripping from 630 to 760. Massive rally. All-time highs. Today, strong jobs report spooks the Fed rate outlook. S&P pulls back to 735. Panic returns. Time to sell. But here is what the data actually says about days like today. 9 of the top 10 single-day rallies in the S&P history happened during bear markets and crashes, not bull runs. It's the opposite. Missing just the 10 best days in a 20-year window has historically wiped out the majority of buy and hold investors' total return. And those best days, they come right after the worst ones. Investors who sell on a day like Friday are often the ones who miss the bounce tomorrow. I'm not saying that rates can't go higher. I'm not saying that tech can't fall further. What I'm saying is, the reference point matters. The market will go down again. It will go down at 800, at 900, at whatever number comes next. The people who build wealth are not the ones who predicted every single dip. They are the ones who stopped confusing volatility with disaster. And as far as rate hikes go, I don't even see that as possible. Jobs always get revised down, and inflation is currently elevated due to oil prices. It only takes a single tweet from Trump that we have a pause in the Iran war or perhaps a peace treaty, and then oil goes back down to 70, and inflation is gone.